Hello everyone! Welcome to Invest Wisdom. In this video, we're going to talk about 8 essential reasons why paying your mortgage off early is important. If you're new to this channel, do like and subscribe to the channel. What is a mortgage loan? Most of the time, a mortgage is a loan from a bank that you use to buy a house, apartment, or other piece of real estate that has both property and land. Most of the time, it's a loan that lasts for about 30 years. And each month, the borrower pays back the amount they borrowed or the principal to the lender. When you get a mortgage, most of the time, you can pay the interest, the principal, the property taxes, and the insurance every month. Interest rates change based on what the market rates are and how much risk your lender is willing to take. The debt-to-income ratio is usually made up of the down payment, credit score, and ability to pay back the loan. According to Investopedia, the debt-to-income ratio compares the amount of debt a borrower has to how much money they make. As a general rule, a borrower's debt-to-income ratio can't be more than 43% if they want to get a mortgage. Lenders like to see a debt-to-income ratio of less than 36%, and no more than 28% of that debt should go toward paying a mortgage or rent. What's good and bad about paying off a mortgage early? Paying off a mortgage early has many benefits. If you pay off your mortgage early, you can use the money you would have spent on the principal and interest payment each month for other things. It also frees up money to invest in other things. Some people might say that you should save money for your retirement instead of paying down the loan on your house. In this argument, the guaranteed interest rate saved by paying off the mortgage is compared to the guaranteed interest rate earned by putting the money in the market. For example, if you can pay an extra $1,000 per month toward your mortgage principal at 3.5% interest, or invest that same $1,000 per month in the stock market at 7%, the argument is that investing puts you ahead by 3.5%. This is right if there are no other problems. But life rarely goes forward without problems. In either case, this is a personal financial decision that depends on your goals, how comfortable you are with risk, and how the market is doing. Have you considered paying your mortgage off early? This is a question that many homeowners often ask themselves. This is also the subject that financial professionals argue the most. According to a recent study of 100 experts conducted by NerdWallet, 56% believe it makes sense to pay off your mortgage as rapidly as possible, while 44% disagree. So, here are 8 compelling reasons to pay off your mortgage as quickly as possible. The first, tranquility of mind. For your own peace of mind, you should pay off your mortgage as quickly as possible. At its foundation, debt removal helps you to sleep easier at night since you no longer have to worry about monthly payments. You know that sense of relief you have after you pay off a bothersome expenses, right? Imagine the sensation on a far wider scale. A mortgage is often the highest debt held by the majority of individuals. Similarly, home debt is one of the greatest obstacles preventing the majority of individuals from realizing their full financial potential, since it often promotes the pattern of deficit spending. Prepayment of a mortgage might be a wise financial investment. Nevertheless, it is a personal financial choice that can only be analyzed and judged with solid financial education. The majority of individuals hold the misconception that financial literacy is innate. In actuality, it is a talent that can be acquired if one so chooses. Second, it generates riches more quickly. During difficult times, Paying off a mortgage early is a fantastic strategy to accumulate money more quickly. This is particularly true during times of high uncertainty since it frees up funds for saving and investing in order to acquire assets that are growing in value. The absence of a mortgage enables you to spend a larger amount of your available cash to capitalize on market sell-offs, asset price depreciation, and other advantageous investment possibilities. Paying off a mortgage is as much about reducing debt as it is about generating wealth, since eliminating debt opens up prospects for long-term investment. Third, savings and investment. Additionally, after your mortgage is paid off, you will have more money to save and invest for the future. Paying off your mortgage is a tremendous achievement that enables you to significantly raise your savings and investment rates. The excess cash flow may be converted into passive income to sustain the desired standard of living. Focusing on saving and investing as opposed to debt payback can shift your financial mindset, as you will be proactively making financial choices for the future as opposed to paying for past errors. When paired with the self-discipline and delayed gratification necessary to pay off the mortgage, your mind will also shift to seek out development and income prospects outside of employment. You can now make money off of compound interest, which will help you get richer. Fourth, financial flexibility. There are several advantages to paying off your mortgage, but the greatest is the increased financial freedom it affords you in terms of prospects. You get more control over your monthly budget since you are no longer paying mortgage payments. A mortgage is a long-term loan that, in addition to interest payments, entails several other costs. This debt may be a colossal financial burden and take years and years to pay off, costing you tens of thousands of dollars in interest over the course of each repayment. If you want to retire early, you must pay off your mortgage as quickly as possible. Paying off your mortgage enhances your capacity to save, invest, and enjoy the results of your efforts, regardless of whether you are financially independent or on the path to becoming so. Therefore, eliminating home debt enables you to concentrate on accumulating wealth. Once you are debt-free, you may work fewer hours and maintain your present standard of living. Keep working the same hours and put in more money, or look into other jobs that will give you more satisfaction, meaning, and purpose. If you like this video, don't forget to like and subscribe to the channel. The fifth aspect is cash flow and net wealth. A house mortgage is the largest obstacle to financial freedom and the genuine building of wealth for the majority of individuals. This is true for various reasons, with debt tolerance and deficit spending being the most notable. When we take a loan or finance something, for instance, we are consuming future revenue streams. While this may be useful when making large purchases such as a mortgage or vehicle purchase, it frequently encourages the use of debt to acquire items we cannot currently afford. Using a credit card to purchase clothing, a computer, or a tree, for instance, we are utilizing borrowed funds in the majority of instances to pay for pleasures we cannot yet afford. As a consequence, we spend more on the products and prolong the debt cycle as a way of life, as opposed to embracing delayed gratification, saving, and investing in order to finance our desired purchases without incurring a permanent cost. As a consequence, after a mortgage is paid off, a person's net worth will improve significantly due to the elimination of their debt. The conventional advice from financial gurus is thus to pay off your mortgage prior to retirement. The sixth is economic resilience. Economic resilience, as defined by United States Economic Development Administration, is the capacity of an institution to avoid, endure, or recover rapidly from substantial disruptions such as shocks to its economic or revenue basis. The government continues to assert that economic resiliency has three fundamental characteristics. First, the capacity to recover rapidly from a shock. Second, the ability to tolerate a shock. And third, the ability to completely avoid a shock. After the worldwide pandemic of 2020, the capacity to avert, survive, and recover from economic disasters became even more evident. In this case, reduced living expenses and income needs increase the capacity to endure income reductions or losses by dipping into savings. Likewise, in recovery, reduced resource consumption improves a company's ability to pursue new or expand current revenue-generating possibilities. As of the time of this video, millions of U.S. homeowners are potentially unable to satisfy postponed mortgage payments totaling thousands of dollars. This may result in sales foreclosures or more debt in the long run. The seventh, having a safe location to reside in. Paying off your mortgage significantly improves your future housing and financial stability by removing housing expenses as a significant barrier to retirement. For instance, owning a paid-off home considerably minimizes the difficulties associated with housing. For instance, having a paid-off home might facilitate retiring in place versus assisted living decisions, such as the opportunity to include lodging utilities and usage of property amenities such as a pool in the remuneration package. To offset additional expenses, other possibilities are house hacks with roommates, holiday rentals, and complete property rentals. In addition to the security that comes with home ownership, mortgage-free homeowners are more financially secure than renters due to generally slower yearly increases in property taxes, insurance, and maintenance expenses. The eighth aspect is removing monthly payments. In addition to decreasing your monthly costs, paying off your mortgage eliminates your mortgage principal and interest payments, further reducing your monthly expenses. If you follow the 4% or the 25 times expenses approach, paying down your mortgage also minimizes the amount of the nest egg you need for retirement. For example, a $1,000 monthly mortgage payment equals $12,000 per year, requiring a $300,000 investment to maintain a 4% annual withdrawal rate. Consequently, removing a mortgage payment might substantially lower your retirement savings needs. For instance, you may spend an additional $1,000 every month on trips or charity donations. Thank you for watching. I hope you have learned something from this video. If you like this video, give us a like, subscribe to the channel, and comment down below. Thank you and goodbye.